The American dream. When you hear that phrase, maybe you think about the promises that means to you about, life and liberty and happiness, and how the American dream is shaping up in the real world, focusing this week on housing.
And I want to raise a specific kind of case study here, which is in the housing market. What we're seeing now is that with rising interest rates, obviously new investments are more expensive.
A lot of folks say, well, we've had rates like this in the past, but what we haven't had is rates and prices this high simultaneously.
My payments today are way higher than the rent I'm charging. That's not factoring in property taxes. And I feel really bad to have those families move to other properties just because the landlord is not making enough money.
So if you could just use that as a sort of case study of how you're going to navigate these cross currents.
You've seen very, very large, as you know, increases in housing prices over really since the beginning of the pandemic. All over the country, you have housing, people, 5 bids above the ask the second the house comes on the market. Well, that's cooling off now to a more sustainable pace.
So where should investors look in this backdrop?
I think that with all the data coming out, we're looking at a moderated home price appreciation scenario.
The latest inflation data revealing a cooling in the housing market, but prices are still too high for many Americans.
Housing inflation has definitely been cooling down, but what that means really is prices are still growing, but at a way moderate level that we have seen in the past 2 years.
How do you navigate increases in interest rates when a lot of the drivers of price increases are beyond your control?
Many indicators suggest that fewer people are visiting homes. The wait time for selling a home is increasing. Housing sales are moving down.
After the height of the pandemic, residents from places like Los Angeles and Seattle moved to more affordable, less congested cities like Spokane to work remotely, outbidding residents with spiking inflation and mortgage rates, forcing would-be buyers to keep renting in a now less affordable market.
And overall, it's a slowing in the housing market.
I do not expect home builder confidence to come back anytime soon. As you saw, it's plummeted and it's expected to continue to plummet.
In the case of the housing market, what you're seeing is higher mortgage rates. So you're actually seeing demand move down quite significantly.
Experts say less financial incentive to build and hold rental units mean less will be constructed.
We expect that the cash flow position will continue to worsen in the years to come as units that are under construction right now that were bought at peak prices come to completion in a higher interest rate environment.
Affordability just remains too constrained with rates above 7%. These are rates that we haven't seen in a really long time, pre-Great Financial Crisis.
Because you would agree, would you not, that increasing the supply of housing can help reduce housing prices, right?
Sure.
Yeah. We've seen housing starts fall by 14% in May. So that means fewer housing opportunities, less supply, fewer workers engaged in building new homes.
So anything from construction workers, durable goods manufacturers, materials folks, everything that's related to real estate starts to deteriorate whenever you have transactions down this much.
Good news for landlords, but a supply squeeze could make renting even less affordable.
What we hope is we can get demand to that part of the economy to slow to a more sustainable pace.
Keeping a cap on inventory levels is going to be the saving grace of the housing market, no doubt.
And get the housing market back on a more sustainable path where there's a better balance between supply and demand.
That's just going to put continued pressure on the ability to buy and sell a home. And so what that's going to do is increase the demand for rental housing.
Those renters don't have a lot of options, and they do have more tensions with their landlords.
Many say the rent is too damn high, and experts say it's in part due to the high cost of buying a home.
What is your confidence level that we will have what is generally referred to as a soft landing, where we won't overcorrect in raising our interest rates to the point that it begins to really hurt our economy, workers, and wages.
A lot of those people considering buying that first home are kind of pressing pause on that search, but they turn around and find that their rent has also increased really substantially.
Nationally, rent is more than 20% higher than the start of 2020, according to Redfin. Over 8 million Americans are behind on rent, and 2.3 million experienced a rent increase of more than $500 in the last 12 months, according to U.S. Census data.
Interest-sensitive spending is a very important aspect of how our tools work.
You have the Fed not buying long-term bonds. You have the U.S. Treasury with a high need to borrow, and you also have sticky inflation. So long-term rates could go higher from here.
What is your level of confidence that you can navigate a soft landing for the economy?
To accomplish that is going to depend to some extent on factors that we don't control.
The longer that rates stay above 7%, or even if they go to 7.5 or 8, you're going to have some problems. You're going to have some forced selling eventually.
What that will result in for investors like us is an opportunity actually to scoop up some new inventory and master plan communities.
Unfortunate situations where tenants are forced to crowd into not great conditions, still paying a lot of rent.